Bismillah ar-Rahman ar-Rahim. Alhamdulillahi Rabbil Alameen. Assalamu alaikum wa rahmatullahi wa barakatuh. And a very good morning to everyone dialing in from wherever you are. And for those who are observing Ramadan, Ramadan Kareem. Welcome to session 1 of Cambridge Islamic Finance Structuring Master Season 3. Module 1, the art of structuring Islamic financial products. This is part of a 10-module series called Cambridge Islamic Finance Structuring Master Series. It is offered by Cambridge Institute of Islamic Finance, and this course is designed by myself, and I would be principally responsible for delivering it. My name is Humayun Dar, and I am currently serving as Director General of Cambridge Institute of Islamic Finance. As I said, Cambridge Islamic Finance Structuring Master Series comprises 10 modules. Individually, they are known as IFAPs, or Islamic Finance Access Programs. IFAPs were developed before Cambridge Islamic Finance Structuring Master Series as a whole was developed. So these are individual modules which we have offered in different parts of the world in different times. Module 1 is on the art of structuring Islamic financial products, and this is what we are going to discuss today. Module 2 would be on WAD and its applications in modern banking and finance. Module 3 focuses on structuring Islamic investment products. Module 4 is on innovations in sukuk structures. Module 5 is on the uses of cooperation and mutuality in Islamic finance. Module 6 is on the uses of law of large numbers and financial inclusion structures. Module 7 is on the use of technology for innovation in the context of Islamic finance, of course. And Module 8 is on structuring Islamic social finance products. Number 9, developing profitable non-bank financial products and institutions. Before we conclude this season with Module 10, which is on advanced topics in innovation and structuring of Islamic financial products, which would be, in a way, an extension of our today's module, i.e., the module on the art of structuring Islamic financial products. All these modules, including today's module, would have 3 learning objectives. Today's module has learning objective number 1, which is to introduce you to some basic ingredients of structuring Islamic financial products, and in this context, introducing you to Islamic financial innovation. It is also an intention of this module to introduce you to the process of product development in Islamic banking and finance. It is also an objective to incite you to challenge traditionally held Sharia rationale for permissibility or impermissibility of certain practices. There are 3 corresponding learning outcomes. After having gone through this session, and if you still have energy after going through some relevant material on your own, you should be able to start working on structuring Islamic financial products. If this is not your job already, if you happen to be working in the product development and structuring department of an Islamic financial institution. Also, another outcome is for you to have developed understanding of Sharia rationale for certain Islamic financial practices and products, and you should be able to assess Islamic financial products from Sharia viewpoint. The third learning outcome of this module is to enable the participants to decide upon commercial viability of the products to be developed, so as you understand what to structure and not only how to structure an Islamic financial product. With this one, let's go to the main body of the module. On the screen, you can see a tool, and many of you, especially the younger ones, okay, you would be wondering what is this and what it has to do with the Islamic banking and finance. This is basically a cobbler's tool. And those of you who have seen it under use, you would understand that this is used by the shoemakers, and it has a variety of usages. So if you have a cobbler's tool at hand, one should expect you to make shoes. So this tool will allow you to manufacture, to make shoes easily. Islamic finance chose to operate within a banking framework. Hence, it is expected that Islamic banks would develop banking products. A bank would be doing banking business, and hence, an Islamic bank, because it is a bank, it would be developing banking products. Now, what is a banking product? Banking product in general involves exchange of money by way of borrowing or lending to yield a rate of return based on interest. It's a very simple way of looking at a banking product. If this is a credit card, which is offered by banks, I'm sure, if not all, uh, almost all of you would have a credit card. In case of a credit card, a bank would give you some money and would expect you to return that money. And if you happen to have used the money for a period longer than the free interest period, then you would be required to pay more in the form of interest. So a banking product basically involves exchange of money by way of borrowing or lending. And of course, the ultimate objective is to earn some interest. A non-banking product, on the other hand side, is a goods or service that producer or supplier attempts to sell and make some money out of it. So the major difference between a banking product and a non-banking product would be that in case of a banking product, both legs of exchange would involve money. In case of a non-banking product, one leg of exchange would be a good or service, the supplier or producer of which would attempt to earn money by way of trading in it. So that is a non-banking product. Now, when we look at a bank, a manufacturer, a farmer, a trader, we would see what are their major activities. In case of a bank would be involved in exchange of money only. A manufacturer would be someone who would be making something physical, and by way of selling it, would attempt to earn some money. A farmer would be someone who would like to grow commodities. Again, the objective would be to sell these commodities and earn some money. A trader would be someone who would buy some goods and services and would sell them on to earn some money. So this is, a bank, manufacturer, farmer. In case of a bank, on both sides, there is money. In case of a manufacturer, for example, in this case, a vehicle manufacturer, A manufacturer would make vehicles, would sell them in the market and earn some money. A farmer would grow rice and earn some money by way of selling the rice. A trader, in this case, would buy a motorcycle or buy motorcycles and would sell them on to earn some money in the form of profit. So, looking at these four areas should explain the difference between a trade and riba. The Quran says, "Wa ahallallahu al-bay wa harrama riba." What manufacturer is doing, what farmer is doing, what trader is doing, these are the examples of trade in which one leg is something physical or a service, it could be non-physical, and the other leg is money. And that is a trade, and this is permitted by the Quran. Okay. And making profit, money out of it, this is acceptable as well. In case of a bank, where on both sides of the exchange, money is involved, and if one leg of money is more than the other one, that would be an example of riba, which is prohibited in Islam. So an Islamic bank is a bank, not a manufacturer, and it is not a farmer. However, it pretends to be a trader. The words underlined, they are important. An Islamic bank is a bank, hence one should expect that it is involved in exchange of money for money. It is not a manufacturer, this is not a farmer. However, to escape this prohibition of riba, an Islamic bank may wish to behave or pretend like a trader, because this trading is something which is acceptable in Islam. I have used the word pretension. Okay. However, an Islamic bank could be deemed as a broker. The way the practice of Islamic banking and finance is taking place, it actually plays the role of a broker. And in a very particular way, this would serve as a broker. And I would like to coin a term, which is finoker. So an Islamic bank is actually a finoker. What is a finoker? That would become evident after this example. So in case of a brokerage requirement, there is someone, a principal client. It would advise a broker to buy and sell certain things. For example, a person may ask a stockbroker to buy stocks from the market from a seller and sell it in the market to a buyer with a view to make some profit for the principal client. So this is a simple brokerage relationship between a principal and a broker. How this relationship gets established? Number one, the principal would open and maintain an account with the broker, and in most cases would fund that account as well. So would put some money so that whenever the client advises the broker to buy some stocks, the broker would be able to buy those stocks from the market and would be able to use the funds in the client's account to pay for those stocks. Of course, whenever the time is ready, the client would advise the broker to sell those stocks in the market with a view to make some profit. So the broker would do so, would retain its brokerage fee, and the remaining money, if there is any, would be returned to the principal client. That is a simple brokerage relationship between a client and a broker. What happens in case of an Islamic bank? A client advises Islamic bank that he or she would like to buy something. in this case, we are using the example of a car. So a client goes to an Islamic bank and expresses its intention of buying a car. The bank would assess the application of the client. If the client is creditworthy, trustworthy, creditworthy, and if the bank thinks that this client is okay, it fulfills its requirements, then it would open an account in the name of the client. In this case, the bank would actually fund that account. So would put its money into this account, which would be in the name of the client. Islamic Bank would then buy the car from a vendor and would pay for this car from this client's account, which, as I said, has already been funded by the Islamic Bank. Then Islamic Bank would sell the car to the client, and client would start paying the price in easy installments by way of making payments into this account on a regular basis. So in this way, when we look at this arrangement, this is actually quite similar to a brokerage arrangement, which we discussed previously. So this is why I say that the bank may be, or an Islamic bank may be deemed as a broker or something similar to this one. I said a finoker because in this case, Islamic Bank is not only serving as a broker, but rather it is funding the sale and purchase of the car as well. Hence, this term which I am using, finoker. So what are the 5 or 6 steps involved? Number one, the customer or the client advises the Islamic Bank of an intention, in this case, purchase of a car. The bank opens the account. This is number 2. Number 3 is Islamic Bank buys the car from the market. And number 4 is it pays from the account which it has created in the name of the client. And number 5, Islamic Bank sells the car to the client. And of course, client starts paying into this account on a regular basis. This is an example of a broker financing the sales purchases as well. Hence, I would prefer, for easy reference, I would like to call this role of an Islamic bank as finokerage, or Islamic Bank being a finoker. In this arrangement, Islamic Bank is actually serving as a broker which offers leverage brokerage services in this case. The end result of this whole arrangement is a product which is very similar to a conventional financial product. And this is something Islamic banks have been doing in most cases, whether this is consumer finance, this is corporate finance, or any other product which Islamic banks offer. The objective of product development in Islamic banking so far has been replication of conventional products in a Sharia compliant way. After this brief kind of introduction, I would like to go to the ingredients of structuring Islamic financial products. There could be 4, 5 important ingredients. I would start with the in-depth Sharia knowledge. Because this is Islamic banking and finance, Islamic banking and finance is governed by Sharia. Anyone who is interested in specializing the role of structuring Islamic financial products must have in-depth Sharia knowledge. And specifically, what do we mean by that? The person should have knowledge of Sharia principles, Sharia rulings, and of course, applications of these principles and rulings in the context of financial matters. In other words, anyone who would like to have a role in structuring of Islamic financial products, that person should have good understanding of what is known as fiqh al-muamalat al-maliyah. Second important ingredient of structuring Islamic financial products is knowledge of cutting edge financial technology. By this, I mean the cutting edge financial technologies in general, conventionally as well. So, knowledge of what is happening in the financial markets, this is very, very important for those who would like to structure effective Islamic financial products. And tools and techniques used in the market, new tools, new techniques, innovations in technology applications. This is becoming an important aspect of cutting edge financial technology as well. So, uh, whatever is happening in the conventional domain, this has huge relevance in the context of product development and structuring in Islamic banking and finance as well. So, two things we have so far mentioned and emphasized: in-depth Sharia knowledge and cutting-edge financial technology, especially in the context of conventional financial markets. The third important ingredient is commercial viability. If you have come up with a product which is fully Sharia compliant, and you have used a state-of-the-art financial technology, however, you have failed to assess adequately commercial viability of that product, this could be a state-of-the-art structure, but this would not bring any money to you. So commercial viability is very important in this context as well. So what we mean by commercial viability, basically you must consider what people are looking for. If you come up with something which is very beautiful, but people don't find it useful, then you won't be able to make money out of it. In this respect, you should look into gaps in the market, what the people are looking for, but the suppliers are, for any reason, not able to supply that product. So gaps in the market would allow you to structure something new. Also, you should be looking into market failure or market imperfections. In certain cases, the market doesn't work in a way which is conducive for fulfilling the needs and demand for a certain product, including financial products. So market failure or market imperfections, they should be considered when you are looking for commercial viability of a new proposed financial product. And this applies to Islamic as well as conventional financial products. So in-depth Sharia knowledge, cutting-edge financial technology, and commercial viability, these are three important ingredients of Islamic financial product development and structuring and Islamic financial innovation. The fourth one is whatever you are trying to come up with, it must fulfill an economic need. So identification of economic needs is also important, especially in case of Islamic banking and finance. You should consider why an Islamic equivalent of a conventional product should be developed. I'll give one example. We have Islamic credit cards. A lot of people, including some Sharia scholars, they don't feel comfortable with the idea of developing an Islamic credit card. Why? Because as the name suggests, a credit card offers a credit facility to the users of this card with a view to earn some money, which is in the form of interest conventionally. Because a credit card actually allows the user to have access to credit for which the user will have to pay, this brings this product very close to Sharia repugnancy, because conventional credit cards explicitly are based on interest, but even an Islamic credit cards, because they have become very close to the practice of conventional credit cards. Hence, you should look into the market. If you are in a market, if I give you a specific example, a market like Pakistan, where for very long time, the Sharia view was that there is no need for an Islamic credit card. Debit cards issued by Islamic banks should serve the purpose. It's only recent that two banks, Faisal Bank and Standard Chartered Bank, they have started issuing Islamic credit cards in Pakistan. Before that, because the Sharia scholars would oppose it, the Islamic banks, they never attempted to issue an Islamic credit card. Now, this would be another story how Faisal Bank and Standard Chartered, they introduced this new product in Pakistani market, despite the fact that the general Sharia view on this was that of prohibition. Wider socioeconomic considerations are also important. If you are coming up with the products which are increasing indebtedness in an environment where increase in indebtedness may not be good in a macroeconomic context, you should be sensitive to this aspect of the phenomenon as well. So economic assessment of a genuine economic need, this is very important in the context of structuring of Islamic financial products. The knowledge of regulations is also important and relevant. As a structurer, you should know what are the relevant financial regulations and what kind of Sharia governance framework is applicable. So these are the 5 ingredients of structuring Islamic financial products: in-depth Sharia knowledge, cutting-edge financial technology, commercial viability, assessment of economic need, and knowledge of regulations. In terms of their importance, we have done some surveys over the last quite a few years, I think 6, 7 years now, probably more, because when we say 6, 7 years, we exclude the 2 years of COVID phenomenon. So I think about 7, 8 years we have been doing these surveys, and our respondents, 35% of them, they give number 1 preference to in-depth Sharia knowledge. 30% of them, they say cutting-edge financial technology is number 1. Okay, 16% of the respondents would say commercial viability, 10% economic need, and 9% regulations. 2 are very important ingredients of structuring Islamic financial products: in-depth Sharia knowledge and cutting-edge financial technology. Now, we would actually use at least one example in this module, and most of other modules, we would be focusing on one module to explicate our point. In this module, we would be focusing on what I would like to call lifestyle maintenance financial products, LMFPs. And lifestyle maintenance financial products, their need arises out of what we call asset deterioration. Asset deterioration is a commonly observed economic phenomenon. When I bought this phone, this had, I think I bought it for £900. If I go out in the market and try to sell it, I would be very lucky if I can get £200 of this iPhone. So that is what I mean by asset deterioration. Asset deterioration is something which is very common when it comes to personal items, household items. There are certain assets which appreciate in value in the long run, like homes, real estate property. In the long run, there is a positive trend. Otherwise, in most of the cases, you buy a fridge, I bought an Apple watch recently, and if I want to sell it now, it would fetch a lot less price than what I paid. So when we buy cars, computers, mobile phones, and similar other household items, all of these items, they depreciate in value over time. Now, lifestyle maintenance means what? I would like to make sure that at any given point in time, I should have access to usage of the latest model of a phone or the latest model of a car of my preference and so on. However, when the time comes, okay, if I have not been careful, I bought this mobile phone for X price. After 2 years, I want to go for the newer model. I would not be able to buy that one if I haven't been able to save, or I do not have the money required to make this new purchase. And if we can come up with a financial product, okay, which allows me to maintain my lifestyle, this would have a value and economic need. A BMW iX, this is an electric car, very nice. Okay, it costs about 80,000 pounds today. After 1 year, probably this would be worth half of its price in UK, because the electric cars technology is fast evolving. Maybe after 1 year, a new technology would emerge, which would be a lot better than the one used in BMW iX 4 Series, 4X or whatever now. So replacing this car with a newer model in future will require additional money. And if we can come up with a financial product which allows me to finance this additional purchase, that would be deemed as a positive thing. Apple and some other sellers, manufacturers, and traders, they have responded to this lifestyle maintenance by way of certain products or certain options. In case of Apple, Apple offers trade-in option at the time of purchase of a new model. So if I go to Apple today, they would say, all right, okay, you give this phone back to us. We would evaluate, we would assess and come up with a value. So they say, get 80 pounds to 610 pounds off when you trade in an iPhone 8 or newer. So these days, iPhone 14 is in the newest one. So iPhone 14 Pro Max, if I want to buy, if I take this one, and if they value, if they price my old phone as 500, then as a buyer, I will have to pay another 549 in cash along with the traded in phone, if the price of the new phone was 1,049. So this solves the lifestyle maintenance problem partially. Can we structure an Islamic financial product that allows lifestyle maintenance? Let us look at the example of the car first. A car which costs 50,000 today, year one, it deteriorates in value. Its value goes down to 40,500. Year two, this fetches a price of 36,125 only. Year three, this would be worth 30,706. I'm just applying one formula to come up with this depreciation. At the end of year three, if the newer model or the new model of the same car costs 60,000, the person would require about 20,294, something like that. So that would be the deficit the person would be facing. And if there is a product which fills this gap, that product would be called lifestyle maintenance financial product. So in this case, depreciation, yearly depreciation is 7,500, first year, 6,375 in the second year, and so on. And as I said, okay, 29,294, this is the amount which someone would be looking for. And if a financial product can be developed which fills this gap, that would be considered as a good help. And that actually establishes an economic need as well. You know, we said these 5 ingredients of structuring Islamic financial products. So economic need is established by this need for lifestyle maintenance by most of the people. The question arises, how is the market responding to this economic need? I have given one example of Apple, trade in option. Lexus, a car company, okay, has its own answer to this lifestyle maintenance, and that is offered with the help of a range of packages. The customer has an option to upgrade, retain, or return the car after a certain time period. Normally it's 3 years, but it could go up to 5 years. So upgrading is relevant to the discussion here. Whenever I go to Lexus or any other car dealer, they would offer me a package which would allow me to retain the car after 3 years, or return it, i.e., sell it back, or upgrade it to a new model. Upgrading in this context is relevant to our discussion. So in case of Lexus, what happens? I enter into an agreement with this is sale and purchase agreement along with a finance agreement. So I enter into an agreement with Lexus. Number two, I pay a deposit and I get the car. So I start driving the car straight away and I start paying monthly payments for a certain time period, say 3 years or 4 years or 5 years. When that period ends, I get an upgrade. I get a new car, a new model of the car. So this is what Lexus would allow you. Lexus is a trader, manufacturer, whatever we would like to call them. Can a bank ask a customer? So this is where we are looking for a financial product. Can a bank ask a customer to pay an amount X now or over a certain time period against an upgrade? From Sharia viewpoint, this is a very tricky question. However, we wouldn't go into those details. We would keep the thing simple. The question arises, can a bank ask a customer to pay an amount X, a lump sum amount, or regular payments over a certain time period, so that when the time comes, the customer gets an upgrade? I think the answer could be yes to this one. Example one, how a bank can get involved in this kind of arrangement. We would be using an example of a car here at T naught, which is not mentioned here. A customer buys a car from a vendor, and at the same time, the bank offers a monthly installment of an investment plan. So basically, the bank offers an investment plan to that customer, pursuant to which the customer starts contributing to the plan on a monthly basis with a certain amount of money. So after 5 years, this much, from here to here, this would be the value of the portfolio of the investment plan. At T5, the price of the car which the customer had bought would have gone down to PM5. So it has gone down, and which means, okay, there is a depreciation equal to this much. So depreciation in the car value would be this much. The price of the new car would be PM5. So basically, now the customer would have only this much money. And if it wants to go for a new car, it would have to pay this much price. So which means, okay, there is this much deficit. And the value of the investment portfolio is this much. That increase in the value of the portfolio is, in this case, sufficient for the customer to buy the new car. So what would happen? The customer would sell the car in the market and would get a price of PM5. and it would use the money from its investment plan portfolio to pay for the additional amount in the form of the new price and get a new car. So in this case, basically the bank is offering an investment or saving plan. We don't call saving plans in Islamic banking. Rather, we would like to call it investment plan, because in savings, there are some complications from Sharia viewpoint. So and if an Islamic bank actually has an arrangement with a car manufacturer, they can offer this product along with the sale and purchase of the cars to make this as a relevant lifestyle maintenance financial product. In case of example 2, a bank selling a car on a murabha basis, along with this one, it does something like this one. So bank, when a customer comes to it to buy a car on a murabha basis, the bank sells the car on a murabha basis to the customer. And at the same time, the bank sells an investment plan to the customer. So it becomes, I don't want to use the word bundle prematurely, but this would be actually the case. We would like to call it an example of a bundled product. So the bank sells the car on a murabha basis, and at the same time, it sells independently an investment plan. So this car, which is bought for this, the market price of the car is this much, but because this is a murabha, the bank would like to earn some profit out of this transaction. So the bank charges the customer P mur or murabha price. And of course, this vehicle would depreciate over this period of 5 years. The investment plan monthly payment would be this much, the difference between this red dot and this blue dot. And over a period of 5 years, this would be the increase in the value of the investment plan. Hence, there would be this much money available in the investment plan portfolio at the end of 5 years. The price of the new model of the car at the end of 5 years would be this PM5, which is shown by this black diamond. So the value of, in this case, the value of the investment plan would be good enough for the customer to go for the new car. So the customer would sell this old car for the price of PM5 and would have access to this investment portfolio to top up the money received as the price of the old car, and would be buying the new car by way of paying PM5. So this could be a murabha come investment plan response to lifestyle maintenance, hence an example of a lifestyle maintenance financial product. Can this be made an upgrade product for premier high net worth customers? Normally, this habit of changing to a new car, this is being exhibited by the premier customers or high net worth customers. Other people, they would be happy with their new car purchase now for quite a number of years. But there are, as I'm sure, okay, you are aware that a lot of people, okay, they would like to frequently change their cars or their mobile phones or whatever. This could be used as a lifestyle maintenance financial product. However, the bank or the structurer should be very careful in this respect if they want to use this as an upgrade. So I say yes, if carefully structured and priced. The following factors are crucial in this respect. Number one, the murabha price, PMUR, monthly installment, depreciation in the car value, future price of the new model of the car to be upgraded to. So when I offer a plan for an upgrade, so basically when we say, can a bank says you pay this much money on a monthly basis for 5 years, and that would entitle you to get the latest available model of the same car at that time. Now, for risk management purposes, this is very important that the bank should determine what is the murabha price, how much money the bank is actually earning from this sale, and that would also determine the monthly installment into the investment plan. Depreciation in the car value is very important. Okay, if you have come up with the monthly installment of £100, for example, over a period of 5 years, and the car in question has gone down in value drastically, then the bank's arrangement would be out of money. And similarly, if the upgrade you are promising, if its price has been set very high, in that case, the bank would be facing a financial risk as well. Murabha price, monthly, the amount of monthly installment, depreciation in the car value, and the expectation of the new car price. These are important factors to take into account when offering the previously discussed structure as an upgrade. Now, the product will be commercially viable if income accrued to the bank from the product makes sense. So now we are going into the commercial viability. I have come up with or I have identified at least these two conditions that must be met for the commercial viability of offering an investment plan with a murabha based car financing as an upgrade solution to the premier or high net worth customers. Commercial viability would be determined by these two conditions. Y, which is the murabha profit plus management fee from the investment portfolio, the income of the bank, if it is at least equal to or greater than the value of the investment portfolio minus depreciation in car. And of course, value of investment portfolio and its difference with depreciation in car should be positive, at least equal to 0 or more than that one. So this is one condition. The second one is the price of the new model of the car and the price of the old car at T5 after 5 years, or whatever be the time period we have chosen. That should be less than the value of the investment portfolio minus depreciation in car. So if these two conditions are met, then this is commercially viable for the bank to offer this bundled product as an upgrade to the high net worth individuals and premier customers. So we have actually identified an economic need, which was lifestyle maintenance, and we have determined commercial viability. If these two conditions are fulfilled, then this would be a commercially viable product. How could the commercial viability be ensured? Of course, knowledge of what is happening in the market is crucial. Appropriate intelligence into depreciation of cars must be used. Forecast of the future car prices must also be accurate. Relevant benchmarking for the investment portfolio is also crucial. And actuarial research is also important. So when we are talking about this thing, actually we are extending the scope of activities of a bank. A lot of banks, conventional banks, okay, they would like to assess the credit worthiness of the customer, and based on that one, they would make a decision. Now, Islamic banks, because they claim to be traders, they claim to be not just dealing in money, they have to develop some more expertise if they want to come up with products which are genuinely new and they are different from what is happening in the conventional domain. So in this case, basically, the car financing department of the bank would have quite a few people who would be expert in car. My son, like anyone else's son, they are into cars. Okay, they would know what kind of car is a cool car, it is in vogue, and people are looking for it. Okay, and what is all aspects of cars. So intelligence into car markets, forecast of the future, and this information is readily available, but you would have to come up with a systematic approach approach to all these things if you want to offer the products which are not just lending money and getting some return out of it. This is a slight variation of this lifestyle maintenance product. This could be a simpler one. So we say that I at time T naught, party A, which is a bank, sells to party B a car for a price P. We are generalizing it. We're such that this price P is greater than the market price, which is normally the case in Murabaha. And at the same time, party A, the bank gives a promise to party B to buy back the car for PM, even if the value of the car has depreciated. This is a variation of what we have mentioned previously, an upgrade option. So in this case, basically, the bank sells a car to a customer and says that, after this much period, we would be buying this car from you for its market price now, if you pay us a certain amount, a certain price, which is higher than the market price now. So for example, if a car is £100 or £100,000, to make it more realistic, the bank says, you actually pay us £125, £125,000. It could be in easy installments. And if you do so, then we would be taking this car back from you for the same price as its market price today. Some of you may say that, this is actually very unrealistic. Okay, this doesn't happen. Then how can a seller would say, oh, you pay me this price, and after 10 years, after 5 years, after 20 years, you bring this back to me, and I would be paying you the today's price of this this asset. Let me give you what happened to me, and this is very realistic. I think this was about 8-9 years back. I was in Kuala Lumpur and I bought a carpet, Iranian carpet, from this shop in Pavilion. The guy actually gave me a certificate of origin. Oh, this is an Iranian, Persian carpet, which was made in, I think, Shiraz or Qom or wherever. And he said, whenever, after 10 years, 20 years, 30 years, you want to get rid of it, bring it back to me and I'll pay you the price you're paying today. Actually, this is very common in case of carpets because they increase in value. And there are so many other examples as well. Expensive watches. Okay. The entry level expensive watch is Rolex. Okay. If you buy a Rolex today, after 10 years, it's very likely that its price would be probably 50% more than what you paid for it. I was actually about, I think, 10-15 years back, I bought a Rolex for 7,000. Today, if I check it, that would be about, I think, 12,000-13,000 pounds. So if the seller would have told me that, no, whenever you want to sell it, bring it back to me and I'll pay you the price you are paying today, the seller would be very happy if I go back to them. Okay. So when we come up with this kind of examples, party A sells to party B something, in this case, a car, and saying that, look, you pay us this price, which is higher than the market price. This is P, such that P is greater than PM, the market price. You pay us this price. Okay. After 3 years, we will buy this car back from you for the today's market price. Now, this could be a response to lifestyle maintenance, if not fully, partially. Okay. However, the bank would have to be careful in this case. The first thing would be making sure that it doesn't price the product too low, i.e., this P is not too low, i.e., it's not too close to PM. So if you have charged a difference of only this much, and after 3 years, 5 years, the depreciation in the car price is a lot more than the difference between P and PM, then the bank would be losing the money. All those, actuarial services, looking into the price trends, etc. So your car financing department should be very smart. If you have priced this product too low, then the bank would be losing some money. However, if the price is such that P minus PM is more than difference between PM and PM1, i.e., if the price, incremental price the party A is charging today is more than the depreciation, expected depreciation in the car value, that would be considered as adequate pricing, and the offerer party A, the bank, would be happy, would be making some money out of it. And I'm reiterating, if you want to offer this as a lifestyle maintenance product, this is a simple one. Okay, now you bring this car back to me and I'll pay you the current market price of this one. So knowledge of what is happening in the market is very crucial. Appropriate intelligence into depreciation of cars is relevant. Forecast of future price, relevant benchmarking, actuarial research, all these things would be important if you want to go for this option. So we have actually looked into economic need, commercial viability, and cutting edge financial technology. And basically, this is what we mean by research and all that kind of things, actuarial research, price trends, and the software, you use for this kind of research. They should be sophisticated as to come up with a forecast which is very close to what you were expecting. The use cutting edge financial technology, I think this is extremely important if we want to offer this kind of products. How to ensure that product is actually in compliance with Sharia. In the first example, a conventional bank offering an upgrade, this would not be acceptable, by the way. You said you pay us this much money and we would give you an upgrade. In case of Islamic equivalent, where you offer this investment plan, you have to make sure that the future value of the investment plan is more than the depreciation in the car plus the incremental increase in the price of the new car. It's absolutely imperative to use a Sharia compliant structure to offer this product as an authentically Islamic financial product. A conventional bank may offer the product as a simple financial product that requires the customer to make a monthly payment of an agreed amount, number one. Number two, as long as the customer fulfills all the obligations of the agreement, they will receive an upgrade at the end of the agreed period. There could be penalties in the event of default, and irremediable breaches of the contract may render the customer ineligible for an upgrade. A Sharia compliant product will not be as simple as a conventional product. So number one option would be a Sharia compliant lifestyle maintenance financial product could be structured as a bundle offering Murabaha car financing along with an investment endowment plan. An Islamic equivalent of conventional, if that conventional product was already there, would not be a simple one. You pay us this much money and you would get an upgrade. It's a very simple arrangement conventionally. That is not acceptable from Sharia viewpoint. Okay, so we have to use a proper Sharia structure. In this case, a murabha along with an endowment investment plan. It is important for us, for the structure, to make sure that we do not end up practicing something which is known as selling two things in one contract. So basically selling two contracts at the same time. That is not acceptable from Sharia viewpoint. So and we are using the word bundle here. So if and even in many cases, okay, the regulations would not allow you to do that one. So you have to come up with a bundle in such a way that the two products are offered in a parallel fashion, and there is some kind of independence between the two. Okay. So if you offer this as one product as a condition for the other one, there would be problems from regulation. Okay. And secondly, there would be Sharia concerns as well. The objective of the bundle could be to allow the customer to retain their lifestyle over a period by way of offering them an opportunity to save in such a way that they are able to buy the most recent model of the same car at the end of the financing period of their existing car. Now, that bundle should work like this one. Number one, the bank enters into a Murabha car financing agreement, say for a period of 5 years. At the same time, it offers a saving, investment, or endowment plan to the customer, allowing them to create a value equal to the depreciation in the asset they are purchasing. Of course, this would give a management fee to the bank, and the first arrangement, Murabaha, that would give them Murabaha profit. The customer makes a deposit, the customer gets the car. Remember, I think this was second or third slide where I used the example of Lexus. So we are making it as simple as that one, however, with the Sharia requirements being observed. So step number one, entering into Murabha and selling an investment plan. Number two, the customer makes a deposit. Number three, the customer gets the car. Number four, the customer starts making monthly payments. One payment would be into the Murabha account. The other one would be into the investment plan. Number five, the customer fulfills all the obligations pursuant to the Murabha agreement. The customer may encash the investment plan to finance the upgrade. So this could be given an option. If the customer doesn't want to encash, that could be a possibility as well. If the customer wants to encash but doesn't want to use for the upgrade, this is entirely up to them as well. So this would show that these two things, although they are in the bundle, okay, however, they are independently offered to the customers to fulfill the regulatory requirements and the Sharia requirements as well. So with this one, we have established economic need, commercial viability, cutting-edge financial technology, and in-depth Sharia knowledge. We have ensured that we are not selling two contracts in one. Rather, okay, these two are independent contracts offered to a customer who would like to go for something which could be used as a lifestyle maintenance tool. And of course, this has given us we have referred to the regulations in this respect as well. Overall, okay, this product, whether this would be acceptable or not, okay, we have to come up with an incentive compatibility check. Why the individuals and businesses on the demand side would like to go for this kind of products? Number one, we actually identified in the beginning, but I'm just repeating that this product should attract those individuals who would like to maintain their lifestyle and the businesses that would like to spread out costs effectively. I think for businesses, this is very important. For those of you who are running your own businesses, if you do not spread out your costs efficiently and effectively, that could have some serious implications. Ours is a small business in terms of the number of people. We have, I think, about 20 or 22 people working for us. That means there are at least 22, if not 25 laptops in the office owned by the firm. If the machines have depreciated to a level when we require to change them for a new one, if we have to pay for 25 machines at one point in time, that would have an implications for the budget. So businesses actually, they are looking for spreading out of costs in all cases. You have printers. I've just given you example of one machine, but there are so many things which require changing. So the businesses which are looking for spreading out costs effectively, they would be interested in these lifestyle maintenance financial products as well. It may also help the individuals to reduce their debt eventually. This point is very, very important. And many banks, they might not like this product because of that one. As a bank, if you are offering a Murabha product,
And at the same time, if you're offering an investment plan, this can lead to a situation where the person may not need a murabha based financing in future, which means the bank would be losing the future business. However, when we look at the demand side, this is a huge incentive for people that, if we are saving in case of sale of conventional financial products, or what happens in Islamic banking as well. Basically, the banks, they benefit if people, they keep on borrowing, or if they keep on seeking financing. If there is a product which dampens the need for financing and borrowing, banks would not be happy. However, on the demand side, this is a good thing. Now, the banks, when we look at the banks and financial institutions, what are the incentives for them to offer this kind of products? Number one, the banks, in addition to what they earn in the form of profit on murabaha, ijara, whatever, they would be earning management fee as well. And also this bundle type, the bundle type products will help in retaining customers. When you have two, three relationships with a customer, then retention improves. Also, the banks would be benefiting from cross selling. This kind of arrangement doesn't have any adverse implications for capital adequacy, because this second part, which is investment plan, this is normally offered with the help of a third party. For example, in Malaysia, CIMB Islamic is a subsidiary Islamic bank of CIMB Group. So if CIMB Islamic offers this product, the investment plan would come from CIMB Investment Bank, which would be not the CIMB Consumer Bank. Okay, rather another entity would be offering this one, and the bank would be basically CIMB Islamic would be distribution center. From supply side, this seems like a commercially viable product and commercially competitive product as well. For the industry as a whole, if Islamic banks, they come up with a new product like this one, they would be deemed as industry leaders. And if this product is successful, conventional banks would follow them, which would give rise to a new kind of Islamization. A lot of banks, they would be offering this kind of products without even having to call themselves Islamic. If the product offered by an Islamic bank of this type is successful in the market, this would force conventional players to offer this kind of products as well. For governments, this could be an attractive product as well, because this would increase the savings rate in the economy. And as you know, from macroeconomic viewpoint, higher is the saving rate in a country, better and more sustainable the economy would be in general, if that is the case. Now, because we are going towards the end of the module, let me have a check on the learning objectives. Now, whether we have been able to achieve the three learning objectives. I would not go into all the three learning objectives. Rather, I would pick, say, learning objective 2. So we said that it is also intended to introduce the participants to the process of product development in Islamic banks and other Islamic financial institutions. Actually, we have gone through this process, but a lot of steps, they were implicit. So to make sure that we have achieved this learning objective, I would like to show this screen to you so that you are clear how product development would be experienced as a process in an Islamic bank or Islamic financial institution. So we have discussed this example of upgrade products. So identification of economic need. This would be done by way of a market research, by the research department of the bank, the need for asset protection and maintenance of lifestyle. Okay, so this, or a concept note would come from somewhere, maybe research department or one of the financing departments of the bank. So this concept paper would be shared with the Sharia team. So Sharia assessment is important. This is a new thing we want to do. What does Sharia think about this one? So they would look into it, whether this is something in compliance with Sharia, or whether this should be considered as an insurance and takaful product, or this could be a guarantee kind of product. Investment management and bundling, all these things would be actually discussed and assessed by the Sharia department. And this Sharia assessment would come from Sharia department. Number 3, commercial viability. That would be that would go to the business development or new product development team, and they would look into what would be the effect of this one on revenue generation, what kind of risk we would be accumulating, and what kind of risk mitigation processes would be there. So that is what happens in the new business department, along with risk, legal, and other guys. Regulatory issues, of course, capital adequacy, regulations on selling third party products, all those things would be looked into by compliance and legal, and probably risk department as well. Cutting edge financial techniques, how to structure, whether it's a kaful insurance or an investment product, all these things are discussed by different departments. Any department which is looking for a new product, they would come up with a concept note. This would be shared with the Sharia department, then the risk guys and risk and compliance guys, legal guys, and of course the technology guys. They would be asked as well whether this is something they can implement given the technology of the bank. What we have discussed today, this is an example of innovation in structuring. And admittedly, there has been a lack of innovation of this type in Islamic finance post global financial crisis of 2009, 2010. Since 2010, we have seen a lot of technology related innovation happening in Islamic banking and finance, which is consistent with what has happened in the conventional market. So there has been a lot of emphasis on blockchain, cryptocurrencies, fintech, etc. Any conference on Islamic finance you go to, they would be talking these days about fintech. A couple of years back, there was huge emphasis on cryptocurrencies, Islamic cryptocurrencies, and Islamic blockchain, and all that kind of things. But I think the enthusiasm has receded a bit in case of cryptocurrencies, but fintech is still a huge focus in Islamic finance. As I said, innovations in Sharia structuring, they have been placed on the back burner. The example we have used, this is actually an example of Sharia structuring. Before we stop, I would also like to check whether we have fulfilled learning outcomes as well. Again, I'll go to learning outcome 2, which reads like this. The participants must also be able to understand Sharia rationale to critically evaluate and assess Islamic financial products from a Sharia viewpoint. And to check that one, I would like to ask this question. Party A pays £100 upfront at T naught as price of a commodity X, which party B is going to deliver on a later date, T1. So at T1, if the market price of the commodity is £110, party A's benefit of £10 is an example of unjust enrichment, or what is known in Arabic as aklul mal bil batil. The question is this statement true or false? We have Haja Mass HM. So Haja, would you like to unmute yourself and answer this question?
Can you repeat the question, please?
All right, again, I'll just go there. This one. Party A pays £100 upfront at T naught as price of a commodity X, which party B is going to deliver on a later date, T1. At T1, if the market price of the commodity is £110, party A's benefit of £10 is an example of unjust enrichment. Is this statement correct or false? So basically, look, at T naught, this was the market price. Okay. Party A pays £100. Okay, so party A is this much upfront at T naught as a price of a commodity, which party B is going to deliver at T1. Now at T1, the price of the commodity is 110, this one. This means party B is worse off by £10. And basically party A in this case would get the delivery of the commodity and would sell it in the market and would earn £10. So these £10, is this an example of unjust enrichment, aklul mal bil batil? What? So
No.
No? Yeah, you are right. Okay, basically, thank you very much. Basically,
You're welcome.
this is a depiction of a salam contract, and salam would allow you to benefit in this case. Okay. Hence, if I have paid upfront £100, okay, and at the time of the delivery of the this asset, the price has gone up in the market. So this is basically a windfall from Allah subhanahu wa ta'ala. So the price has gone up. Okay, so I would be benefiting from this one. So this is not unjust enrichment. A related question is whether this can be used as an Islamic option contract. This is something we would be discussing in another module. So if you want to learn about this one, so you would have to register for the Islamic Finance Structuring Master Certificate. So Salam as an option contract, this is just to give you an idea. Salam as an option contract can only be used for commodities, okay, not for stocks, because Salam cannot be used to buy and sell listed stocks. And with this one, we have finished the time allocated. Thank you very much, all of you. Hopefully, some of you would join us for module 2, which would be on WAD and its applications in modern banking and finance. And hopefully, we will see some of you for all the 10 modules, which we would be conducting as live Zoom sessions. This was the second repeat session of module 1, because quite a few of you could not attend, I think, because of Ramadan. And so we thought of repeating it, but we would not be repeating the other modules. Okay, so thank you very much and stay blessed wherever you are. Assalamu alaikum wa rahmatullahi wa barakatuh.